Coming to profitability ratios. Profitability, as you know, as you all understand, the main objective of coming into business is profitability. We are all in the business to earn profits. So we need to understand that how profitable our business is, so that we know that our capital is safe, our loans are safe, we will be able to pay off our loans, our creditors are safe, and also so that our business grows over a period of time, right? So starting with the gross profit ratio. What is gross profit ratio? Gross profit ratio is gross profit divided by net sales as a percentage. And what is gross profit? Sales minus cost of goods sold. Now suppose if I'm selling a pen, my cost to purchase the pen, cost price is 10, and I'm selling it at 20. So sales is 20, cost of goods sold is 10. What's my gross profit? 10. 10 divided by 20 into 100. 50% margin, right? So what is it? Gross profit divided by net sales into 100. A high ratio, a high GP ratio, gross profit ratio, indicates that the business is performing efficiently, that the business is doing good, it is making profits. And a low GP ratio, a low gross profit ratio, a low gross profit ratio means that the cost of goods sold is high, that your direct expenses are high in comparison to your cost is higher in comparison to the sales being made. So there could be various reasons for cost being on a higher side. Cost could be high because your raw material is being purchased at a higher cost. There is stiff competition in the market. The stock turnover ratio is not good. Your machinery is old and not able to produce as many goods in an efficient manner at low cost. So your production could be inefficient, your purchasing could be inefficient. When I say GP ratio, I only have to see the direct costs. You need to reconsider your purchasing policy. You need to see your production department. You also need to see the sales side, whether your marketing team is doing good enough to sell your product, or it requires investment in plant and machinery. So this all, whether your losses are too high, whether your wastage is too high. So gross profit ratio is a direct indicator of how efficiently are you working. There could be high indirect costs. GP ratio is a direct indicator as to how your core business, as to how your core activity is performing. The core activity, the reason why you are there to do business. The gross profit should be enough to cover your direct costs, and to cover your other expenses and to give you good profits. Okay. And GP ratio is generally compared with other firms in the same industry. That if I am producing product A and company B is producing product A, then we compare our GP ratios to understand where we are going wrong. If there are major differences in our GP ratio, indirect expenses could depend upon various other factors. Rent, where is the factory situated? My factory could be situated in a place where the rentals are high, and your factory could be situated in a place where the rentals are low. There could be some legal dispute for our company, so legal expenses would be high. Legal expenses for me, but zero expenses for you. How much do I pay salary to my staff? Are they underpaid? Are they overpaid? These indirect costs have many factors to be looked into. But GP, gross profit, which is sales minus direct costs, cost of goods sold, will tell you about your core business. And if the GP is not correct, then there is no point staying in business. You might as well stop production of the goods that you are selling. Okay. Then how much you can play with your, now I will write the examples and show you, because Vishal was not comfortable in my speaking and showing you. So just give me a minute. I will just note down the, now suppose I'm doing here the gross profit ratio. Sales in year 1, year 2, sales is 1,20,000, 1,60,000. Gross profit is 40,000. And here it is 60,000. So the gross profit ratio would be is equal to gross profit divided by net sales into 100. So what would this be? For year 1, it would be 40,000 divided by the sales as a percentage. This would be 33%. And for year 2, it would be 60,000 divided by 1,60,000 as a percentage. And this would be 37.5%. That means my year 2 is doing much better than my year 1. Now, my dear friends, if my indirect expenses are, let's say, are 20%, okay, and these are COVID times. Suppose this is 2020 and this is 2021, okay. Now my indirect expenses are 20% only, this much I know. And in these COVID times, the product is not selling. So because I know my GP ratio is 37.5%, that means my gross profit is 37.5%, and my indirect costs are 20%. I can reduce my selling price by around 15%. Okay. So if my selling price comes down to around by around 15%, still I will be able to cover my expenses and still I could be in my profit. Suppose here 1,60,000 is your sales and I reduce it by 15%. So 1,60,000 into 15%, which is 24,000. So how much would that be? 1,60,000 minus 24. Now this is if my sales are this. So gross profit is 60,000 divided by 1,36,000 as a percentage. Still higher. So I can reduce my costs, price, and still gain. To cover my indirect costs. So I can reduce my selling price. So this is why you can use your So this is why how you can use your gross profit ratio to determine whether you will be able to sustain in the market or not. Your gross profit will also reduce so this would become okay. So you can play around with your costing and still be sustainable in the market with your gross profit ratio. Because that is your direct cost. It will help you determine your direct income, gross profit. Now, I'm giving you another example. If the cost of goods sold sales is 6 lakhs, everybody can note it down. Yes. If sales is 6 lakhs, and cost of goods sold is 4,80,000, what would be the gross profit? What would be the gross profit? Tell me what would be the gross profit? विशाल आप बताएं. विशाल, you tell me. Yes, 1,20,000. 1,20,000. 6 lakhs minus cost of goods sold, gross profit. So gross profit ratio would be 1,20,000 divided by 6 lakhs as a percentage, 20%. Vishal, is it clear now? Is it clear now? Good. So what does this say? I will do the earlier examples. Okay. So the gross profit should cover the operating expenses and provide for fixed charges, dividends, and accumulation of reserves. The operating expenses include office and administrative expenses and selling and distribution expenses. So this is what they're saying, that a gross profit should be able to cover all of these expenses. Sometimes high gross profit ratio is possible due to overvaluation of closing stock and undervaluation of opening stock. This could also be a possibility. Sometimes window dressing happens. So we need to be very careful. We are here trying to understand when things are being done in the right perspective. So gross profit should be able to cover your operating expenses, should provide for your fixed charges, fixed expenses should be covered, dividends, which you want to pay to your shareholders, return on investment, and there should be some reserve for future business growth. Office expenses should be covered, administration expenses should be covered, selling and distribution expenses should be covered. Okay. Coming to operating ratio. What is operating ratio? Operating ratio coming to operating ratio. Operating ratio is which covers your operational expenses. It tells you operating costs to net sales. Operating cost divided by net sales into 100. Okay. How much are your operating costs in proportion to your sales? So it does not only cover the direct cost. Here it was only covering the direct cost. But here it covers the direct cost and other operating expenses like administration, selling and distribution. So it is operating cost divided by net sales into 100. And what is operating cost? It is cost of goods sold, that is direct cost, plus operating expenses. Okay. Now, to give you an example, here, cost of goods sold is 6 lakhs. That means these are the direct costs. Then operating expenses are, let's say, 40,000. Sales is 8,20,000 and sales return is Now you tell me how much is the operating ratio. Quickly. Tell me. Yes. Twinkle as a percentage. As a percentage. What you're telling me is an operating income. No, not 12.5%. Check. Check again. Twinkle and Kaushika, right? Look, cost of goods sold is 6 lakhs. Plus operating expenses. 6,40,000 is your operating cost. Operating cost divided by net sales. Net sales, 8 lakhs. So this would be 6,40,000 divided by 800 as a percentage. 80%, correct. Clear to all? Say yes. Raise your hands if it is clear to all. Raise your hands if it is clear to all. Okay. Yes. Good. Good. Aruna is not responding. Karn is not responding. Karn, what happened to you? Okay. Now, another important ratio, which is net profit ratio. What is net profit ratio? Net profit divided by net sales into 100. What does the net profit ratio indicate? Net profit ratio shows you the net efficiency, overall efficiency of your business. That means now we have covered the indirect costs also. Indirect expenses also have been taken care of. And higher the net profit ratio, the better. That means the company is doing good. That means this is the net profit after covering all sorts of costs. My business is doing a net profit of 20%, 30%. Lower the ratio, that means somewhere either your expenses are on a higher side or your sales pricing is on a lower side, or you are not able to do enough sales. You are not able to sell enough goods to get you a good net profit, or your capital expenditure is high in a particular year. Okay, and generally when we take profit, net profit over net sales, the profit should be before tax, generally. Because tax is a statutory liability we need to pay, we have no option. But how is the business doing? Profit before tax. Generally, it is taken as profit before tax. Now, suppose if your profit is net profit is 2,30,000 and your tax is 29,000. Your sales are 13 lakhs. Sales return are 50,000. What would be your net profit ratio? What would be your net profit ratio? Tell me, what would be the profit? No one? Is somebody attempting? Very good. How did you calculate? I think it's wrong, Kausika. As I told you, you need to take profit before tax. Profit before tax. So your net profit will be 2,30,000 plus 29,000. 2,59,000 divided by 12,50,000 as a percentage. 20.72, correct. Because I told you, net profit should be profit before tax. Yes, this is net profit. This is profit before tax, 2,59,000. Okay, got it? Net profit is generally after tax. Profit before tax divided by net sales. Okay. Clear? Now, the most important operating profitability ratio is return on investment. Whenever I put in my capital, whenever I start to do business, I need a good return on my investment. I need a good return on my capital. So it tells you the ratio between or relationship between the profit and the capital. So profit or loss. Profit before interest and taxes divided by capital employed into 100. Profit before interest and taxes divided by capital employed into 100. It shows that if I invest capital of this amount, what is the return I am getting on my capital employed. Suppose, for example, just a small example, profit before interest and tax is 6 lakhs. Capital employed is 39 lakhs. So the return on investment is equal to 6 lakhs divided by 39 lakhs as a percentage, 15.38%. This will show that my capital is getting a return of 15% in the business that I am doing. Okay. Now, I will give you an example. You want me to give you another example? I'm not finding a small example. Okay, we'll take up this example now. Suppose net profit after tax is 1,20,000. Tax is 1,68,000. So what is profit before tax? Profit before taxes? Profit before tax is quickly tell me. We will add these two and it will be 2,88,000. Yes, good Vishal. 2,88,000. And if the capital employed is if the equity share capital is 50,000 and reserves and surplus is 1,50,000. Preference shares is 50,000. And capital employed is capital employed is 2,50,000. Absolutely. Equity capital plus reserves plus preference shares. 2,50,000. So my return on investment would be profit before tax divided by capital employed as a percentage. Very good percentage. 115.2. Okay. Correct? Is that correct? Everybody got it? Now, if you want, you can note it down. We did liquidity ratios. First, current ratio. Then we did quick ratio. Okay. Then for solvency ratios, we did debt equity ratio, we did total assets to debt ratio, and we did solvency ratio. Then for activity ratio, we did stock turnover ratio, we did debtors turnover ratio, and we did working capital. For profitability ratios, we did gross profit ratio, we did operating ratio, and we did net profit ratio, and lastly we did, we did return on. Now, these are the ratios that we have covered. Now, again, as Vishal said that I was going very fast, for everybody's benefit, I will take this up slowly once again so that you all understand. If you have any problems, let me know. Talking about the current ratio, which is current assets divided by current liabilities. This ratio shows the short-term financial soundness of a business. How much current assets are there with the company to cover the current liabilities. The ideal ratio is 2:1. That means we should have twice the amount of current assets to cover our current liabilities. And what are current assets and what are current liabilities? Asset is what we own and liabilities is what we owe. Asset is what is my money which I own, which I should be getting. And liability is what I need to pay off in the market. That means I should have twice the amount of money in my business to pay off my liabilities, Okay. Clear? So this is the current ratio. So what are current assets which can be converted into cash over a period of 1 year quickly? Okay. Okay. Now quick ratio. Quick ratio is quick assets divided by current liabilities. The ideal is 1:1. What are quick assets? Other than current assets, less stock and prepaid expenses. That means which can be quickly converted into cash. Stock will take some time to convert. Prepaid expenses, I don't think we can convert them. Once we paid in advance. So this is quick ratio. So it is considered to be, to let you know the very quick short-term financial position of the company. Ideally, this should always be 1:2. Debt equity ratio, that how much capital you have to cover your long-term debts. Higher the ratio, better it is. That means the shareholders' funds, the owners' funds are more than the debts taken from the outside. This ratio judges the long-term financial position of the company. Lower the debt equity ratio, higher the degree of protection enjoyed by the lenders. So this is debt divided by equity. If it is less, that means your equity is more than the debt. Total assets to debt. This ratio measures the safety margin available to the debtors. How much debt is covered not only by equity, but by assets also. So this is total assets divided by long-term debts. This tells us that how much total assets I have to cover my long-term debts. Not only equity, not only the shares capital, the assets also, which will cover my debtors. Solvency ratio, again, assets divided by how solvent I am. Assets divided by liabilities. Where it was found out that how much solvent I am. Generally, 20% solvency is considered to be a good ratio. Then, stock turnover ratio. What is stock turnover ratio? Cost of goods sold divided by average stock. That means how quickly do I sell my stock? Conversion of stock into sales. This ratio measures how fast the stock is moving through the organization and generating sales. Higher the ratio, higher the efficiency. But sometimes it can lead to working capital issues. Debtors turnover ratio means sales divided by average debtors. That how quickly do my sales get converted into cash? If I have sold goods on credit, how quickly do I recover this credit from my customers? How quickly do I recover my outstandings, my debtors, from the sales that I have made? This indicates the efficiency in the collection of amount due from debtors. Higher the ratio, better it is, because it indicates that the debts are being collected quickly, and so the chances of bad debts, chances of doubtful debts is less. Working capital ratio is net sales over net working capital. Sales over working capital. That means the ratio shows the number of times the working capital is employed in the process of carrying on the business. Higher the ratio, that means your working capital is being utilized in a better manner. Okay. Gross profit ratio, your GP to sales. Your gross profit to net sales. Operating ratio, your operating expenses to net sales. That means, are your operating expenses being covered by your sales? Net profit ratio, that means net profit divided by sales. A higher net profit ratio, better the business. Higher the profits, good the business is doing. It's working more efficiently. And return on investment is profit before interest and taxes divided by capital employed. It tells us that how is the company performing overall? What is the overall efficiency of the company, and what is the return on investment being provided to the owners of the business? If I have employed capital in a business, is it giving me good returns? If it is not giving me good returns, I better put that money in a fixed deposit and earn minimum interest. So return on investment should at least be more than what a fixed deposit gives me in a bank, which is bare minimum. So if I have 100 rupees, should I put it in business or should I put it in a fixed deposit in a bank? Will depend upon the return on investment ratio. If my return on investment is more than what I will earn keeping my money in fixed deposit, for sure I will go for the business. But if my return on investment is say less than the interest being given to me by my fixed deposit, then why will I do the business? I rather go and put my money in fixed deposit and sit quietly, isn't it? Okay. Now, let me see if I have left out anything, then I will take your queries. Working capital is current assets minus current liabilities. This we have already done. Now, previous activity, let us see if I've left out any. No, this we have done. No. Yes, we have done one, we have done two, we have done five, let's see. We have done this liquidity ratio, debt ratio, profitability, efficiency, value. B, do the ratio analysis to assess companies' liquidity, leverage, growth margins, profitability, returns. Liquidity ratio, current ratio, quick ratio, operating cash flow ratio. These are various forms of liquidity ratio. Debt ratio, debt to equity, interest coverage, debt service. Efficiency, inventory turnover, accounts receivable, that means debt turnover ratio. Profitability, gross profit, operating margin, return on assets, return on equity. These are certain other ratios which are given: book value per share. What is the value of per share based on the equity available? Dividend, how much dividend can be attributed to the shareholders? These are only specifically in relation to companies. This is how a balance sheet looks like: asset side and liability side. Asset side, cash, accounts receivable, that means current assets and fixed assets. Liabilities, current liabilities and non-current liabilities, and your capital. Assets is equal to liabilities plus capital. That's what I told you. On one side, we have the liabilities and the capital, and the other side, we have to have our assets, and they both should add up. They should be equal. A company has to pay for its assets by taking on liabilities or taking up from investors, that means shareholders' money. Further, the assets and liabilities are separated into current assets, non-current assets, current liabilities, non-current liabilities. This is how a balance sheet looks like: current assets, non-current assets, current liabilities, non-current liabilities, and equity. Equity could be share capital. If it is a non-company, then it could be your proprietor's capital, partnership firm's capital. This is how a balance sheet looks like. Okay. Any other questions? Any questions? Any questions? Okay. Vishal wanted me to take up the example of current ratio and quick ratio. So Vishal, I will take you through that. You can come on the screen, this screen. Where is that screen? This. Current ratio. Current assets divided by current liabilities. The example that Vishal, you want me to do this or have you understood? Should I do it? Vishal, tell me yes or no. Okay. Now, if your debtors are 100, your prepaid expenses are 10, your cash is 30, your short term investment is 20, your machinery is 7, your bills payable is 200, your creditors are 40, your debentures, your stock is 40, your expenses payable are, now what are the current assets? Current assets are your debtors plus prepaid expenses plus cash in hand plus short-term investments plus stock, which is, this is your current assets. And your current liabilities are your bills payable. Sorry, this is 20. Your sundry creditors, your expenses paid. This totals up to 100 plus 50 plus 40 plus 10. This is 200. This is 100. Your current ratio is 200 2:1. Clear? Clear? Now, if I want to take out quick ratio from this, and from the current assets 200, I will reduce the stock of 40 and my prepaid expenses of 10. My quick ratio is 150 divided by 100, which is 1.5. So my current ratio is 2:1 and my quick ratio is 1.5:1. That means my company is secure. That means I have twice the number of assets to cover my liabilities. Even if the assets are double, my quick assets, that means all the assets which can be converted into cash quickly, leaving aside stock, leaving aside prepaid expenses. I have 150 rupees in hand to pay off my liability of rupees 100, which is good. Here I have 200 rupees to pay off my liability of rupees 100. Generally, it should be twice the amount. Clear? Clear? This is how you will analyze any balance sheet, any profit and loss account for the purpose that you are trying to analyze it for. Any questions? Tomorrow we will do the comparison of income statement.